So, so this is the second recording. My first recording actually corrupted, so I have to record the whole video again. So I'm sorry for that. Let's start. Let's get into the video. Most people who look at most people who look at how to manage money arrive at the same conclusion. They say you cannot do both. You either you either are a turnaround investor or a trader. The time frames are different, the mindset is different, the discipline required is different. Trying to run both simultaneously means you're not fully committed to either. And in capital markets, lack of commitment is expensive. I've heard this argument many times from experienced investors, from people whose judgment I respect. And I want to address it directly, not defensively, not precise, but precisely. Because the argument is not wrong. It is it is the general it is the general case. Most people who attempt to run two strategies simultaneously do it poorly, but they blur the boundary, they confuse the time frames, they bring the impatience of a trader into the long term into their long term positions, and the compliancy of an investor into and short-term trade into the short-term trades. The failure mode is real and it is common. What I want to show you in this video is why I approach this is structurally different from the failure mode. Not because I'm immune to the psychological pressures that causes it, but because the two strategies I run are deliberately designed to regulate each other psychologically, technically, and financially. So instead of this being a X, it is more like a plus. This is not a video about how to swing trade. I covered that already. This is not a video about how to find turnaround investments. I covered that too. This video is about architecture, about these two strategies running simultaneously with clear boundaries and a coherent framework. Produce something more robust than either strategy alone, and about what that architecture is ultimately being built towards. If you followed this channel from the beginning, the swing trading framework, the yes bank deep dive, the turnaround versus value trap analysis, this video is the one that ties up everything together. And if you're watching this video for this channel for the first time, everything I say in the next 30 to 40 minutes, maybe even longer, will make more sense after you've watched those three videos. Links are in the description. I'd encourage you to start here. For those who are still here, let's get into it. Before I explain why these two strategies work together, I need to define each one precisely, because the large part of why people think they are contradictory is that they're working from imprecise definitions. They hear swing trading, they picture day trader glued to a screen, constantly chasing momentum. They hear turnaround investing, and they picture a value investor sitting patiently in a losing position, hoping for a recovery. Those imaginations are not imprecise. They are actively preventing you from understanding why these two approaches can coexist coherently. So let me define both with the same precision I apply to when I'm actually managing these books. Time horizon. For the turnaround book, it's multi-year. The thesis on a turnaround book, turnaround investment is measured in years, not quarters. When I buy a business that market has mispriced because of a fixable problem, I'm not expecting the return to be recognized in a month. I'm expecting it to be recognized when the evidence is undeniable, which typically takes 1 to 4 years from the point of entry. The timeline is not a bug, it is a feature. The market's impatience at that time horizon is precisely what creates the opportunity. Swing book is weeks to maybe months. The overwhelming majority of my swing trades, roughly 85%, close within a year, and most significantly sooner than that. I'm not holding for multi-year compounding in this book. I'm looking for a specific move in a defined setup with a specific defined time window. When that move happens, or when the conditions that are justify the trade no longer exists, I exit clean and disciplined. Same investors, two different relationships with time. The primary driver is fundamental analysis for turnarounds. The entry decision is driven almost entirely by the answer to one question: has the market mispriced this business because of a problem it believes is permanent, that I believe is fixable? Everything else, the valuation, the technical setup, the macro environment, is secondary. I'm not saying that these are not important. I'm just saying that these all are done after the fundamental analysis. Except the technical. The technical is done before, just for filtering. If the diagnosis is wrong, nothing else matters. If, if the diagnosis is right, everything else will eventually follow. For swing book, it's a deliberate combination of technical and fundamental analysis. Approximately 60 to 80% of my uh, if of my setup is technical, and 40 to 20% of it is fundamental. The technical side tells me when to enter: price action, market structure, momentum. The fundamental side tells me whether the business I'm trading has a backbone to support the move I'm anticipating. I never trade pure technical setups on business I know nothing about. But I also never enter a swing trade purely on fundamental conviction without the technical setup confirming the timing. Two different analytical frameworks applied in two different books with clear boundaries between them. Entry condition. Turnaround book has the 7 question checklist I covered in detail in the turnaround versus value trap video. Every position in the turnaround book started by passing all seven or most of the 7 questions, three binary gatekeepers, and four graduated calibrators. No exceptions, no shortcuts. And of course, the turnaround book needs to pass the technical setup too. Otherwise, it will end badly. The swing book um, primarily trades on technical and fundamental alignment. The setup must have a technically clear price action confirming the direction, structure supporting the entry, and volume behavior consistent with the thesis. And the fundamental backdrop must provide conviction, a business that is capable of moving the way I'm anticipating for a reason that goes beyond the charts. Both books have explicit entries conditions. Neither book has discretionary entries made on gut feel or narrative alone. The conditions are different, but of requiring the discipline of requiring conditions must be met before capital is deployed is identical. The sheer discipline to applied to different frameworks is one of the most architectural features that make the two books coherent then rather than contradictory. Primary virtue: turnaround book, patience and the ability to hold a consistent, correctly diagnosed positions through extended periods of price action stagnation, negative sentiment, and apparent underperformance, while the thesis develop at its own pace. Patience in this context is not passive. It is it is the active management of conviction and the face of the and the face market noise that would otherwise drive premature exit. Swing trading it's discipline. The ability to enter when the setup is present, exit when the thesis parameters are met or broken. Do not overtrade during the period when the market is not presenting a clear opportunity. Discipline in this context is not a restriction. It is the active protection of capital from setups that don't fully justify the risk. Now here's the observation most people miss when they argue these two strategies are contradictory. Patience of Patience and discipline are not opposite. They are they are two expressions of the same underlying quality. The ability to act when the conditions are right and wait when the anxiety without anxiety when they aren't. A patient investor and a disciplined trader are practicing the same fundamental skill just in different time frames. The investor waits years for the thesis to play out, the trader waits weeks for the setup to confirm. The waiting looks different on a calendar. The psychological and the analytical quality of waiting is identical. A return source. For turnaround, it's a value re-rating plus earnings recovery. When a turnaround thesis plays out, two things happen simultaneously. Earnings improve as the business recovers, and the multiples at which those earnings are valued expand as the market perception shifts from distressed asset to a normalizing franchisee. That combination, earnings growth plus multiple expansion, is where the significant returns in turnaround investing are generated. Neither alone is sufficient, both together is where the asymmetry lives. Swing book: capturing specific price moves within the defined window. The return is generated by identifying a setup which where price is likely to move in a specific direction over a specific time and positioning to capture that move with defined risk and defined exit conditions. The return is not from holding through multi-year recovery. It is from reading a setup correctly and executing the trade with the discipline. Two books, five dimensions, five clear distinctions from every axis. No, not contradictory, different deliberately, structurally different, designed to occupy different spaces in a portfolio, both analytically and temporarily. Now, understanding the definitions is necessary but it is not sufficient to explain why running both simultaneously produces something better than running either one alone. For that, I need to make three separate cases: the psychological case, the technical case, and the financial case. So let's start with the one that most people look and overlook entirely. Let me make the psychological case first, because this is the argument most sophisticated investors find surprising. The conventional wisdom says running two strategies simultaneously creates psychological conflict. The reasoning the reasoning goes like this. If if you're actively trading in the short-term book, you cannot maintain the patience required for a long-term book. The activity on the trading trains your brain to expect feedback, to expect movement, to expect resolution, and and that expectation bleeds your long-term position, making you impatient, making you check prices too frequently, making you interpret normal periods of stagnations as advice that something is wrong. That is a legitimate concern, and I said in the hook, it describes the real failure mode. That if expect that affects people that affects most people who attempt to run two strategies. But it assumes something that isn't true in my case. It assumes that strategies compete for the same psychological resource. They don't. Let me explain what I mean precisely. The swing book funds the patience that the turnaround book demands. Here's the psychological reality of long term investing that no one talks about. Patience is not free, it has a cost. And that cost is anxiety of holding a position that isn't moving while the rest of the market is generating returns elsewhere. That anxiety left unaddressed is what causes long-term investors to sell too early. Not because the thesis is broken, but not because the fundamentals have changed, but because the psychological discomfort is sitting still while capital appears to be doing nothing eventually overcomes in the intellectual conviction that the thesis is intact. I know this because I felt this. Every long-term investor who is honest by with themselves has felt it. The swing trading book addresses that anxiety directly. When capital is actively working on a shorter cycle, when trades are being evaluated, entered, closed, and at a regular frequency, more psychological pressure that builds up during the quiet periods of turnaround book turn turnaround investing is relieved, not eliminated, but relieved. Because the question that creates the anxiety, should I be doing something else with this capital, has an answer. Yes, I'm doing something. In the other book, the turn-on positions can breathe because I'm not staring at them every morning looking at the movement that the thesis doesn't require it. That breathing room and the ability to let the turnaround develop at its own pace without the psychological pressure of it feeling like the capital is idle is one of the most valuable things the swing trading book provides. And it has nothing to do with the returns of the swing trading book that it generates. It's purely a psychological architecture benefit. The turnaround book grounds the discipline or the swing trading book demands. Now the other direction. The greatest enemy of a swing trading performance is overtrading. Entering setups that don't fully meet the framework because capital is just sitting idle and inactivity feels uncomfortable. Taking trades because the market is doing something interesting rather than because the specific conditions of the sound trade are present. The turnaround book addresses this directly, not by imposing a rule, but by providing the reference standard. When you spend significant time doing the level of analytical work that turnaround investing requires, like reading the annual reports, understanding dynamics, competitive dynamics, building a financial models, looking at the technicals, applying the 7 question checklist, reading con calls before committing any research time. The standard of rigor becomes your baseline. Your definition of what sufficient analytical work looks like before deploying capital is calibrated at a higher level. That calibration bleeds into the swing book. When you evaluate the swing setup, even a shorter term trade where the 20 to 40% fundamental layer of the decision is of the decision, you are applying the same underlying standards of analytical rigor that the turnaround book demands. In the swing trading book, the bar for "I understand the business well enough to trade it" is higher than it would be if the swing trading book existed in isolation. That higher bar means fewer trades that don't meet the framework, which means better average trade quality, which means better swing trading performance, not from finding better setups, but from rejecting more setups that don't fully justify the risk. What the diagram shows and what I want you to take from this section is that the psychological relationships between the two books are not is not competitive. It's regulatory. The swing trading book regulates the anxiety that long-term investing creates. The turnaround book regulates the overtrading tendency that the short-term trading creates. Each book is providing something the other book generally needs, not as a luxury, but as a structural requirement for performing well in that strategy over a long period of time. Now, I want to address one objection directly before I move on, because a sophisticated investor have already formed it. The objection is this: couldn't you achieve the same psychological regulation through other means? A more structured journaling practice, a stricter trading plan, a better self awareness about emotional states. Why does the regulation need to come from running a second strategy? It's a fair question, and the honest answer is yes, in theory, psychological benefits I've described could potentially achieve through could be potentially achieved through other mechanisms like I've mentioned. But in what but here's what those mechanisms cannot provide. They cannot generate return while providing the regulation. The swing trading book is not just a psychological tool, it's a capital generating operation that simultaneously happens to provide a psychological architecture that the turnaround book needs to function at its best. The regulation by its product by the regulation is the byproduct of a strategy that is independently worth running for financial returns alone. This is the difference between a psychological crutch and a structural design feature. A crutch compensates for weakness. A design feature turns what could be a weakness into a strength. Running two complementary strategies is a design feature. The psychological regulation is what it produces alongside the financial returns. This is the psychological case. Now let me show you the technical case, the analytical argument for why running both strategies will make you better at each, not just psychologically but analytically. The psychological case explains why running two strategies make you mentally better at each one. The technical case explains why it makes you analytically better on each one. Uh, and I want to be precise about it. What I mean by analytically better, because it's not just a abstract claim about general intelligence, about broad market awareness. It is a specific claim about two concrete skills that cross pollinate between the two books in a way that produces measurably better decisions for both directions. Let me explain each direction of the cross pollination separately. The swing book to the turnaround. Technical precision. The turnaround investing is a fundamentally long-term fundamental exercise. The thesis is built on business analysis, what went wrong, whether it's fixable, whether the franchisee has survived, whether the management has real genuinely changed. The chart in the most traditional value investing frameworks is either ignored or entirely treated as secondary consideration. I don't ignore it, and the reason I don't ignore it is because the swing book keeps my technical reading sharp enough to use it meaningfully. Here is here is what I want. Here's what I mean by in practice. When I'm building a position in a small cap turnaround business, I have extensive fundamental work on, and that has passed the 7 question checklist, and that I have genuine conviction in. And I'm not just asking whether the business is undervalued. I'm also asking whether the chart is all set up for the well entry. Is the stock in the base building phase accumulating quietly with declining volume on days due on down days, and it's increasing on up days? Or is it still in active distribution where the sellers are constantly overwhelming buyers at every rally? Is there a technical level that, if broken, would confirm that the market sentiment is beginning to shift and the direction of my fundamental thesis anticipates? These technical questions and answering them honestly and correctly, knowing the difference between the stock that is genuinely base building and the and that is still distributing allows me to time entries and turn around more precisely than a purely fundamental investor can. That precision matters more than most fundamental investors acknowledge, because in turnaround investing, where the thesis takes 2 to 3 years to play out, being 6 months early on the entry is not just an inconvenience, it is a 6 month of capital tied up in a position that's going nowhere or even in a loss. While the psychological pressure of holding a non-moving position builds, the technically informed entry, one that waits for a base building confirmation before committing full position size, reduces the pressure and improves capital efficiency of the positions over the full holding period. The swing books provides that technical skill, not as a separate discipline, and I that I apply occasionally to long-term positions, but as a continuously maintained capability that stays sharp because I am actively practicing it every time I evaluate a swing trade setup. From turnaround book to the swing trading book is the fundamental trigger. My swing trading framework is approximately 60 to 80% technical and 40 to 20% fundamental. I I I covered this in the frame swing trading framework video. The technical side tells me when to enter, and the fundamental side tells me whether the business I'm trading has a backbone to support the move I'm anticipating. The fundamental layer, even at 20 to 40% of the decision, is where the turnaround book makes the swing book meaningfully better. Here's a specific mechanism. Because I spent a significant amount of time doing deep fundamental work on turnaround investment, understanding balance sheets on a granular level, evaluating management quality, assessing competitive dynamics, reading annual reports carefully rather than superficially. My baseline standard for what understanding a business means is calibrated at a high level. When I apply that standard to a swing trade candidate, even a trade I intend to hold for weeks rather than years, I'm I am asking better questions than purely technical swing trader would ask. Not just does the chart look good, but does the chart look good? What is the fundamental developments that drive this price action? Is this the volume? Is the volume behavior consistent with institutional accumulation, which requires a fundamental reason for institutions to be buying, or is it retail momentum that has no fundamental anchor? That distinction between technically strong setups with fundamental support and technically strong setup without it is one of the most reliable filters for swing trading, for a swing trade quality that I have found. And it comes directly from the analytical standard of turnaround the book maintains. Let me give you a concrete example of what this looks like in practice without naming a specific stock. Earlier this year, I evaluated a swing trade setup that was technically compelling. The chart was clean, the base was forming, the declining volume on the consolidation, a well-defined resistance level that, if broken, projected a meaningful move by purely technical criteria. Better. It was one of the better setups I've seen in several months. But when I applied the fundamental layer, even even at a lighter touch required for a swing trade rather than a terminal position, I found something that gave me pause. The revenue recovery visible in recent results was concentrated in one segment. The other segments were flat or declining. The apparent fundamental improvement the market was pricing into the technical setup was narrower than the price action suggested. I passed on the trade. 3 weeks later, the stock broke out, moved exactly as the technical setup projected, and then gave back the entire move when the next quarterly results confirmed that the recovery was narrower than the market priced. I'm not telling you the story to claim I predicted the outcome. I'm telling you it because the fundamental layer asking whether the recovery was broad based or concentrated. A question I ask every month for my turnaround positions caught a risk that a purely technical analysis would have missed entirely. This is what cross pollination looks like in practice. A question developed in one book applied in another, producing a better decision. The diagram now shows four things. The swing trading book funds patience to turnaround book, which is psychological. The turnaround book grounds discipline in the swing trading book, which is which is also psychological. The swing book provides technical precision to the turnaround book, which is analytical, and the turnaround book providing fundamental trigger to the swing, which is also analytical. Four directional benefits, two psychological, two analytical, all of them all of them flowing from the same structured decision to run uh, to run two complementary strategies with a clear boundary and a coherent framework connecting them. Now I have made the psychological case and the technical case. Both of them are how the strategies make each other better. How the whole how the whole is greater than the sum of the part at a level of the investor, a person managing both books. The third case is different. It is not about investor or about the portfolio. It is the financial case. It is the argument that I think most of anyone evaluating this mm, I think matters most to anyone evaluating this approach seriously. The psychological case and the technical case are both argue that running two strategies at one individually makes us better at one individually. The financial case argues something different. It argues that two strategies together produce portfolio architecture that is more robust than the entire book could produce alone. Not because one book compensates for the weakness of the other, but the return profiles are structurally complementary in the in a way that creates something genuinely superior to either in isolation. Let me explain what I mean by a return profile, because this is a concept that anchors the entire financial argument. Now look at the turnaround returns here, right here. The turnaround is a lumpy. That is the turnarounds are returns are lumpy. That is the honest characterization I want to be precise about. What lumpy means is in context because it is not a criticism or structural feature. It is a structural feature of the strategy. Turnaround thesis that plays out over 2 3 years does not generate smooth monthly returns across the period. It generate what it generates is extended period of apparent stagnation where the position is flat or slightly negative. The while while fundamental recovery develops beneath the surface, followed by sharp re-rating moves when the market finally recognizes what the fundamentals have been showing for months. The return is real. The timing of its arrival is non-linear, and the non-linearity creates two practical problems. First, psychological, which we addressed in section 3, um, extended periods of stagnation creates anxiety, or even extended periods of downtrend creates anxiety too. If unmanaged, it leads to premature exit before the re-rating occurs. Second is financial, and it is the most it has the most problems in this section addresses. The capital sitting in a turnaround position for 12 months while the thesis develops is capital that is not compounding on a monthly basis. The annual return when the re-rating arrives may not be exceptional, but the monthly return profile they lived they lived experience of managing the positions is of a long stretch one of the long stretches of nothing punctuated by significant moves. For a fund manager or anyone um, who eventually be accountable for the external capital, that return profile requires explanation. It requires the ability to say, month after month, during flat periods, the thesis is intact, the position is developing, the patience is justified. The explanation is easier to make, the easier for the investor to accept. When when the overall portfolio is not also flat at the same reason for the same reasons. Now look at the swing trading return profiles. Here we go. Swing trading returns are more consistent, not dramatic, but meaningfully. Individual trades close regularly, wins and losses accumulate into monthly returns that are variable. Do, does not exhibit the intended flat periods of turnaround investing that produces. But the turnarounds are a little bit more volatile because of their nature. So if they're not flat, they might be a lot up, or might be like they might have a little bit of of a downturn too. So swing trades help minimize the downside while maintaining the upside. The the ceiling of an individual swing trade is lower than the ceiling of a successful turnaround thesis. I'm not holding a swing trade for 3 years, capturing a 300% free rating. I'm capturing a specific move within a specific window, a return profile that is inherently bounded by the time frame of the trade. But the floor is also higher. The sense of that frequency of closed position provides a regular data points on whether the process is working. Every closed trade in in a thesis tested and resolved. That resolution, positive or negative, is information, and information passes pos- processed through disciplined framework, compounds better than the future decisions. Now look at now let's look at the total returns. Now look at what happens when both books operate simultaneously. First of all, I made I made three I made three scenarios: a normal market, a down market, um, a down market, and an up market. A bear, a bull, and a normal market. So as you can see, the allocation of swing trades in the normal market is almost similar as to turnaround as to what we started with, which was 60-40 split. But in the bear market, this is what usually happens. In the bear market, swing trades are less volatile, so they go down less, and the turnarounds go down a lot. So the allocation for the swing trades increases, and our our inherent risk decreases because the turnarounds are down and the swing trades um, are on the same point, or they're a little up or a little down. So this means if we had a 20% loss in the turnarounds and we had a 10% profit in the swing trades, we would have something in between. Or maybe if we had break even, if we were break even in swing trades, something in between would have been a return, which would decrease our risk or volatility. So this is what I mean. And in a bull market, swing trades decrease and turnarounds increase because swing trades are moving normally, but turnarounds are moving rapidly because the re-rating is happening. So this time we have we have more upside, less downside, because the swing trades are protecting downside while moving up little by little, and the turnarounds are making most of the return. During the periods when turnaround book is flat or in the negative, the thesis developing phase, the swing trading book is generating consistent short cycle returns. The the overall portfolio is not flat or in the down. It is active. The capital is compounding in one book while patience is being exercised in another. During the periods when the turnaround thesis re-rates sharply and swing trading book continues to operate normally, adding to overall return without the turnaround book without the turnaround book move being diluted by competing drag elsewhere. The combined line is smoother than the turnaround book alone because the swing trading book fills the flat periods, and the combined line has higher ceilings than the swing trading book alone because the turnaround events when re-rating events when they occur, add- they add, they add to an already functioning shorter cycle return engine. The combination smoother without sacrificing upside. What is the portfolio architect? What portfolio architects call what portfolio architects call structural complement, not diversification in a conventional asset allocation sense. Different asset classes, different geographies, different sector. A structural complement at a strategy level, two running profiles that occupy temporal spaces within the same portfolio, each providing the what the other cannot. This often produces asymmetrical return, where the risk relative to the return is low. Now, I want to make a distinction that is critical to understanding why this architecture matters. It is not the hedging argument. Hedging involves in taking positions that move in opposite direction, so that when one loses, the other gains. The turnaround book and the swing book are not hedge, do not hedge each other. They can lose money simultaneously. A bad market environment can compress both books simultaneously. There is no mechanical protection in one book against the loss in the other. What the architecture provides is not protection against losses, it's consistency of the process across different market environments. In a strongly trending market, the swing trading book finds clean setups and performs well. The turnaround book develops its thesis and at its own pace, regardless of the trend. In a choppy, directionless market, the swing trading book becomes more selective. Activity reduces, returns moderate. The turnaround book continues to develop its thesis at the same at the same pace because fundamental recovery is not correlated with short-term market direction. In a market downturn, both books face pressure. The turnaround book faces it on the fundamental thesis. Did the business deteriorate rather than the price level? A falling price is in a genuine turnaround is in with an intact thesis is not a loss. It is an opportunity to add better prices. The swing trading book it faces at the setup level. If clean setups are not present, activity reduces and the capital is preserved rather than deployed into poor risk reward situations. But the thing is, in my swing trading strategy, um, it doesn't really have that. Like, so basically, my swing trading strategy involves basically buying the dip. So in a market downturn, my swing trading strategy can also benefit from that. It's not a momentum strategy because I am a contrarian by nature. So a momentum strategy won't fit me. So I have a contrarian swing trading strategy. So in a market downturn, I can get um I can do swing trading in that, and I can do swing trading in large cap stocks and make quick bucks with that. The architecture is designed to keep the process consistent across different market environments, not to eliminate losses, not but to ensure that the capital is always being managed according to the coherent framework regardless of what the market is doing. The consistency of process of framework of analytical standards applied across different market environments over a long period is what actually compounded returns are actually built on, not the individual brilliant trade, uh, not the single exceptional turnaround that returned 400%, but the consistent application of a sound process in both books through good markets and bad ones, both without the framework breaking down under pressure. This is the financial case, and I've taken together the psychological case and technical case and the financial case. They form a complete argument why this architecture is not a contradiction; it is a design. But now, but I want to go one level deeper. Why most? Because the most important question about this design is whether it works theoretically. Um, it It is what it is built on. Build. Okay, cut this one. But I want to go one level deeper because the most important question is about this design is whether it works is not whether it works theoretically. It is what its ultimate being built. What is what? Okay, cut this too. Cut this too. Okay. I but I want to go one level deeper because the most important question about this design is not whether it works theoretically. It is what it is ultimately being built towards. And that is what we're gonna cover next section in the next section. Everything I've shown you in the last 1 hour, the psychological regulation, the skill cross pollination, the return profile architecture, has been how this has been the how. This section is the why, not the immediate why. Why two strategies produce better adjusted return. That one. The case has been made. The deeper why, what is the construction is ultimately in service of. I want to be direct about something that I think is important for anyone watching this channel to seriously understand. The way I manage money today is not the end state, it is the preparation. Every position I manage in the turnaround book, every thesis I build, every thesis I build, monitor and update publicly, the is building a document, a verifiable track record how I think about long-term capital allocation, not the back-tested track record, not the hypothetical one, the real one, built in real time, real capital in public. Every swing trade I execute in the swing book, every setup I evaluated, every close trade broken down, every, on this channel is this channel is building a document, a verifiable track record on how I think about shorter cycle capital deployment, the discipline of the entry, the integrity of the exit, the honesty of the post-trade analysis. Together, both books managed simultaneously, documented publicly across every month updates, are building something that cannot be manufactured, cannot be reciprocated, res, restro, respectively, retrospectively constructed, can and cannot be faked. A body of work. Now, I want to explain why running two strategies simultaneously rather than one is specifically important for what body of work is building towards. What that body of work is building towards. A fund that runs a single strategy, a single condition bet, it performs when the strategy is in favor and underperforms when it isn't. The track record it builds thus is the track record of one approach tested in the market conditions that happen to exist during the period of the measurement. It is that is useful evidence, but it is incomplete evidence because a single strategy track record cannot tell you how the manager thinks across different market environments, different analytical frameworks, different return horizons. It can only tell you how they performed in one context. A manager who runs two complementary strategies documented publicly with clear framework boundaries between them, with honest monthly reporting on both is building evidence across multiple dimensions simultaneously. How they think about long-term fundamental analysis visible in the turnaround book. How they think about the shorter cycle technical and fundamental integration visible in the swing book. How they manage the interactions between two visible in the monthly update that shows both books developing simultaneously. How they handle losses in both books visible in the honest reflections section of every monthly update. How they adapt the framework even market conditions change, visible across 12 monthly episode over the full year. That multidimensional evidence built publicly in real life without the ability of retrospectively editing the difficult month is a fundamentally richer body of work than the single strategy track record in the same duration. And here is the thing about building a work of body, body of work publicly. The the most people underestimate. Public accountability changes the quality of a decision being made. When I know that every monthly update will show both books' performance, when I know that every thesis I, I built will be documented and tracked publicly, when I know that every exit or entry, every scorecard assessment will be on the record, the standard is of rigor I apply to every decision is higher than it would have would be in a private context. Not because I am performing for the audience, but because public commitment to a framework creates the strongest possible accountability structure for maintaining that framework under pressure. When a turnaround thesis is underperforming, the temptation to rationalize holding is the strongest. The fact that I have publicly stated the thesis break conditions keeps me honest. I cannot quietly lower the bar without a record showing that I lowered the bar. When the swing trade setup is almost right but not fully right, in the fact that I have publicly described the entry conditions that keep me disciplined, I cannot quietly expand the framework to justify the entry without the record showing that I expanded it. Public documentation is not just a content strategy; it is a disciplined infrastructure. Now I want to address something directly that a sophisticated viewer will have been thinking about for several minutes. Everything I've described, two books, to the framework, the public documentation, the body of work being built, is preparation for managing capital at a larger scale. That is not a secret. It is it is the explicit purpose for this channel, stated from the beginning. And I want to be honest about the preparation. The preparation looks like from the inside. It looks like every month the same format, the same analytical standards, the same honest reflection, whether the month was good or bad, whether the position moved or didn't, whether the swing book was active or quiet, the consistency of the process, the applied applied month after month, without the standard dropping, is what the preparation actually consists of. Not an individual, not the individual brilliant analysis, not the month where everything went right. The consistency, the standard maintained under pressure. The framework applied the same way in difficult month as an easy one. Because the most important thing a future investor in any fund needs to know about the manager is not whether they are capable of brilliance. Brilliance is episodic and unreliable. What they need to know is whether the manager is capable of consistency, whether the process holds when markets are difficult, when positions are underwater, when the narrative is going against the thesis. This channel, these monthly updates, these deep dives, this framework documentation is the answer to that question being built in real time, not claimed, not demonstrated. This is this is what the word foundation means on this slide. Not foundation as in starting point, something to be left behind as operations scale. Foundation is a structural base. The thing is the thing that everything is built above. It depends on its integrity. Two books running simultaneously, documented publicly, managed with a consistent framework are not the temporary practice version of something more serious that comes later. They are they are the serious thing already. The scale will change, the capital behind the framework will grow, the number of people whose money will be managed will increase, the framework, the analytical standard, the entry conditions, the monitoring discipline, the honest reflection will be identical to what the what you're watching right now. Because the framework that requires more capital to function properly was never a sound framework. A sound framework works in any scale, and the only way to prove that it is to demonstrate it at the scale you currently have, publicly, consistently, without lowering the standard when the audience is small. That is the big picture. Two strategies, one architecture, one body of work being built deliberately in public, in real life, one month at a time. Let's bring everything together now. Let me bring everything together now. We started with a contradiction, a conventional wisdom that swing trading and long-term investment turnarounds are fundamentally incompatible. That you cannot be both. That trying to be both means you're neither. We spent 30 minutes to we spent 1 hour actually. We spent more than 1 hour dismantling that contradiction, not by arguing because because it's against emotionally, but by building three separate analytical cases for why the specific combination I run is structurally coherent. The psychological case, the two book the two books regulate each other. The swing trading book funds the patience. So the turnaround demands. The turnaround book grounds the discipline that the swing trading book demands. Each book providing what the other generally needs, not as a luxury, but as a structural requirement. The technical case, the two books cross-pollinating analytically. The swing book keeps analytical precision sharp enough to time turnaround entries more accurately. The turnaround book keeps fundamental rigor high enough to filter swing trade setups more selectively. Each book making the analytical work in the other book better. The financial case. The turnaround books are the two books are structurally complementing each other. each other's return profile level. The swing book fill the the swing book fills the flat and the down markets that the turnaround book in that turnaround investing inevitably produces. The turnaround book provides significant re-rating rate returns that the swing book alone cannot generate. Together, smoother than either alone. Higher ceiling, higher ceiling than either alone. This produces asymmetric return. And underneath all three cases, the bigger picture, two strategies running simultaneously, documented publicly, managed with a consistent framework, building a body of work that demonstrates capability across multiple dimensions. The real in real time without the ability of retrospectively edit the difficult months. The difficult months. The thesis of this entire video in two sentences. Running running two complementary strategies is not a compromise between trader and being an investor. It is a deliberate architectural decision that makes every strategy more robust, more disciplined, and more analytically rigorous in isolation. The framework scales because it was built to work at the scale first, and every month this channel documents the framework operating consistently. The body of work it is building becomes complete and more credible and more difficult to replicate. That is the philosophy. Swing trading framework sits inside it, covered or covered in full in the first video on this channel. The turnaround investing process that anchors it demonstrated by Yes Bank deep dive and the turnaround versus value trap framework. The monthly updates that document in real time, published in the very first week of every month without exception. Everything connects. Everything is a part of one coherent body of work. If you have watched all of it, you now have a complete picture of how I think about capital. Not a partial picture, not a curated highlight reel, the complete picture. Philosophy, process, application, and ongoing documentation. If you are watching this for the first time, the three videos I just referred to are are where I would start. The links are in the description. Watch them in order. Each one builds the last. I'll see you in the next one. Thank you.